Welcome back. In today's video, I would like to talk about the stock selection returns. So here you can see how the stock selection works. You have a video that explains how to use this section, but I want to scroll down here and talk about these different tables. These tables are very important for me because this is my portfolio and this is really a daily measure of my trading activity. So we can see that this portfolio, which started in September 2013, has produced about twice the return of the S&P 500. This S&P 500 produced 27% and I produce about the double or 54%. But what is interesting is that the drawdown, the maximum drawdown, was about half of the drawdown of the S&P 500, which means that I have twice the return for a twice lower drawdown, twice lower risk. Here we can see the win ratio. It is only 54%. This is a very important figure because it means that when I pick a stock on the long or on the short side, I will be right only 54% of the time. So the question is, how can you generate high return with only such a low win ratio? It is because the risk return, the general risk return, is higher than 2. Why is it higher than 2? It's because I always select stocks. I select trades that have a risk return ratio higher than 2. In other words, it means that I cut my losses very fast, but I keep the winning trades for a longer period of time. Okay, let's scroll down a little bit more. This is the what I call the rolling quarterly gains. So that is the total return of the last 3 months. So 17% here is the addition of these 3 months. 12% is the addition of the gains of the previous 3 months, and so on. So you see all these are always positive. Why do I show this? Is because if you subscribe to this service, you will subscribe for 3 months, and I can show you here that I have never had a negative 3 months period. Here of course it's only 1.17%, but it's still positive. If ever I have a negative 3 months period, I will give you another 1 month free until this turns positive. Okay, let's go down to the figures here. So the figures here is the return of the portfolio compared to the S&P 500. You see it's about the same tendencies, but when you have very deep pullbacks like here, the portfolio doesn't pull back. In other words, you have here lower drawdown. This is in blue the drawdown of the portfolio compared to the drawdown of S&P 500. If I do the same analysis on TNA, I see that it's not updated. I will update it here. Sorry about that. Yeah, okay. So the TNA data is updated. You can see that we follow the same trend, but simply TNA moves up and down. It is much more risky than the portfolio. And indeed, you can see that the drawdown on TNA here can be to 50% drawdown. So if you can survive 50% drawdown, then this tells you that you can indeed produce the same returns as the portfolio. Something else that I want to show you is the last trading accident that I had on Friday. Okay, let's go back. On Friday I was short this stock, which is a European rental car company. It's Avis Budget Rent-A-Car. You can see that it had very negative figures, negative. The leasing sector was very negative, and the effective volume was negative. But on Friday, you can see we had a jump in price due to the upgrade by Deutsche Bank, and since my stop was at 45, I had to decide on Friday at what level I would sell the stock. Why sell the stock even if you see traders continue to sell? It's because basically the trade was wrong. The stock was at this level, and so I waited until the price comes back after the few 10 or 15, 20 minutes, and then I sold the stock at about the $45 price. This is typical of a trade accident, and you have trade accidents. So let's see how many trade accidents I showed in the past, I had in the past. I will go here is my list of trades. You see I placed 444 trades up to now, and I will sort these trades by profits. So okay, you can see here the stronger trades are here, the stronger profits, and the lowest profit, I mean the big losses are here. And you can see here that there are only 10 trades that had a loss higher than 4%. Okay, but it's a 4 trade out of 444, which is about 0.4%. So get this in mind. You have 0.4% trading accidents. These are trading accidents. These were not at all expected, and I had to exit on the stop or in a hurry because the trade didn't go well. And then you can see below the number of trades that are higher than 4%. You see, between 398, yeah, 398 and 444, which is about 50. It's a 47. So it means just higher than 10%. So more than 10% of the trade produce a return higher than 4%. This means that this trading strategy is skewed on making larger gains. And if you look now at the average trade returns between 4% and -4%, so I will calculate the average here. Okay, I go up to this level. You see it's slightly negative, -0.06%. So this means that the majority of the trade finish basically neutral, slightly up, slightly down. But when I have a good trade and 10% of the trade are very good trade, excuse me, then the results are very good. Okay, here is the weight of the position within the portfolio. Sometimes I use half a position, which means the weight of the stock of the position is only 10%. For sometimes I use a full position, and then the weight of the stock on the portfolio is 20%, and this portfolio only managed 5 positions. This is big enough for one portfolio. Thank you very much.